Hexaware, backed by Carlyle Group, is all set to make its debut on Dalal Street once again. The company is looking to raise 8,750 crores via an IPO. The price band has been set at 674 to 708, which pegs the company's market capitalization at a little more than 43,000 crore rupees. You're watching IPO KYC. I am Reema Tendulkar, and today joining me is the top management of Hexaware to talk about the way forward and the company's IPO prospects. Let me welcome R Srikrishna, CEO of Hexaware Technologies, and Vikash Kumar Jain, the CFO of the company. Well, you know, Hexaware has had a very rich history. It was incorporated as Aptech in 1992 by Atul Nishar. In 1997, it went public. In 2002, it underwent a rebranding and it was known as Hexaware. In 2013, the company saw a significant shift when Baring's private equity took over. In 2020, it got delisted. In 2021, a year later, Carlyle took over as the promoters, and now here we are in 2025, early 2025. We're talking about Hexaware's second coming on Dalal Street. Gentlemen, thank you very much for joining in. So, Keech, let me start with you. Well, you've always been one of the faster growing mid-cap IT companies. Now your revenue growth over the last 2 or 3 years has been about 13.7%. Now that we're seeing an uptick in the IT industry, are you confident about maintaining this growth run rate?
First of all, good to see you again, Reema. We have a strong history for a number of years of doing better than the industry. Okay, so that's all I'll say. And we feel good about a number of things we've built in the company that are built to last, that we think will keep us on a good performance for a very long time.
So you're confident about outpacing the industry even going ahead?
That's what we've done in the past.
Okay, and what's your expectation of industry performance in calendar year 25?
I don't think the industry is going to tick up in growth materially. 24 was, I don't know, maybe 4.5%. We get a little bit better percentage.
So we're talking about high single digits. Can we push to, at least for the industry, low double digits?
No, I don't think the industry will get a double digits anytime soon.
So mid to high single digits?
I think so, yes.
But for you, at least you're confident about double digit?
We've done quite a bit better in the past. So, and I feel good that there's no reason for us not to sustain that outperformance.
Okay. So let me put it in another way. Are you confident for you this year is going to be better than the last year, given the environment?
That's the hope. It's still our fiscal year and calendar year are the same. So we just started the year. It's been less than or just over a month, and elections have created quite a bit of discontinuity. But in general, the discontinuity is one of positivity. Right? Okay. There's expectation that this year will be better. In general, for the macro.
Okay, better for the macro, better for the industry, and perhaps better for Hexaware as well?
It's in that sequence. If it's better for the macro, it's going to be better for the industry and for us.
Vikash, let me come to you on margins. Margins for the company have come down a little bit in the last 2.5 years. What is the outlook on margins?
I put it this way, that margins have come down from the pre-COVID era, and primarily because of the fact that the margins at that point of time were unsustainable because a lot of the costs were not into the P&L. Visa expenses, travel, utilities. Coming back, we knew that those costs are going to come to play. If you look into our margins on an adjusted basis, our margins have been steadily improving, and that's driven by a lot of operational efficiencies that we have put into motion. Our utilizations are improving, attrition rates are coming down, our offshore mix are improving. So we feel very confident in terms of our current levels of margins and maintaining that.
Okay, so sustaining margins. But forget the adjusted margins because they adjusted for ESOP costs. So currently margins are about 15.2, 15.3% in terms of the EBITDA margins. That's the run rate which should sustain. And what's the reason for the drop? It's just COVID era margins were higher than usual.
No, one of the reasons was, one was the COVID era, the margins were higher than the usual. The other aspect was in the year 21, we saw that we saw that there was a significant uptick in demand. And at that point of time, we made a conscious call in terms of going for the market share gain, not leave the market share for short-term margin pressures. And at that point of time, we also had to pay competitively in terms of retaining and attracting talent because the attrition rates were very high. So those were the reasons, and those were specific investments that we made to build our long-term business, which has actually helped, if you see, in terms of delivering growth, which has been much faster than from an industry perspective. On the margins, the adjustments that we did are truly one-time in nature, and that's why we presented an adjusted view. So we would say that our adjusted margins, what we have reported, are the ones which are the baseline for us.
That's the baseline. And is there scope to expand margins?
Well, the operational improvements are in play. We expect that the operational improvement will continue, but we'll see how it plays out. We feel very confident about the current levels.
Confident about current levels. Keech, while you've been higher than the industry now, some of your peers have grown faster than you. Just to name, say, a Persistent from the RHP. Coforge has been doing very well. What, according to you, is the reason why some of your peers have done better than you?
First thing I'll say is that we've done better than the vast majority of the industry, and we've done it for a very long time. Of the two names you mentioned, one is certainly doing better. Other, I think, there are some ups and downs. There are quarters when you do better, and there are quarters when they do better. But what is true is this, that there is always an opportunity for us to do better. And we are always looking for what can we do to do better. We put some strategies out. Look at specific white spaces, geographic, service line, vertical capabilities. So we are always thinking about what can we do more to grow faster.
And can you outline the strategy in terms of white spaces, geographical expansion?
I'll give you one example. Okay, we built this platform called RapidX. RapidX, we think, is the best enterprise-grade software engineering platform. There's a lot of talk in the industry that GenAI is going to reduce the need for software development. And that's very focused on one narrow aspect of software development, which is coding. But actually, coding is only 20% of a full software development life cycle. RapidX solves for the entire 100% of a software development life cycle, not just the coding, which is what everybody speaks about. We think, as an example, RapidX will open material new sets of opportunities for us in legacy modernization, in forward engineering. So that's an example of a capability we've invested in, which we think will accelerate growth for us.
Okay, that's in capability. But in terms of geographical expansion, you refer to it?
So the two markets that I think we have an opportunity to do more, if you look at global macros, right, the two economies, large economies that are decoupled from global macros, Middle East and India. And we think both these are markets that we can do better in.
And what is your current contribution from Middle East and India?
It's marginal.
Okay, but
Very small.
Very small. Low single digits, like sub 5?
In percentage terms,
Yeah.
not a much lower. I mean, it's like 25 million or so, or thereabouts in revenue.
So even if it grows, even if it doubles in size, it's not going to be material to move the needle.
Unless it doubles for several years continuously.
And you see that kind of an opportunity?
We think there's an opportunity to become bigger in Middle East.
Okay. One of your strategies which seems to have played out is broadening your client base or growth beyond the top few clients, and you've struggled a bit, especially on your top 2 clients. So first, talk to us about why your top 5 clients have underperformed the company growth rates.
I'll say kind of 2 things. One, that the way we report this, the top 5 clients are constant. So it's a constant period. If somebody grows really fast, it's a new list now, right? So it's growing slowly for a period of time is a precondition to somebody who's doing better to get into that list. So actually there are clients that are doing really well that have got into the top 5, okay? Or will get into the top 5 in future. I think the second thing is important for companies of our size. Client concentration is a big issue. Anytime we have a major client going through a downturn, it could lead to a dip in performance. We managed over a period of time to systematically focus on and reduce that client concentration risk. Right now, our top 5 clients is just over 25% of revenue, which has come down materially from what it used to be in the past. So I think it's a good thing for us that we've managed to reduce our client concentration.
What was it in the past? The top 5?
3 years ago, it was 30%.
30%. Now down to 25%. And you want to bring it down lower?
Little bit.
Little bit.
Yeah.
What's a comfortable level?
I think, 30, or it used to be even higher in the past. That was uncomfortable. Okay. We are in reasonable comfort zone now, but a little bit reduction is not a bad idea.
Little bit. I think your top 2 clients are, government mortgage companies in the United States, and they've struggled a bit over the last couple of quarters. And now again, we're talking about the possibility of no Fed rate cuts going forward, which would have otherwise benefited them. What's the outlook on these 2 particular clients of yours?
So we've named one of them the RHP, Fannie Mae. So I could speak to Fannie Mae, what their business is and what we do for them, right? They are in the business of keeping the liquidity engine, the US economy going. So they're not actually the ones that are selling mortgages directly. They are writing underwriting rules and pricing rules for other companies that sell mortgages. So they're one step removed from the ups and down cycles of the mortgage industry.
Any of your clients facing any challenges? Any specific clients? Headwinds?
None, which is, if there would have been anything meaningful or material, we would have disclosed it into our risk factors. So if you look into our risk factors, there has been no mention of anything which is not in the normal course of business.
Do you see any headwinds as you look out in this year?
Macros, potentially. Are client specific? No.
What about Europe, auto? It's a bit downbeat, the sentiment there.
So we don't have a significant exposure to the auto industry.
Okay. And any other sectors where you see any kind of pressure?
If there are broad-based tariffs, it can impact a lot of sectors.
Okay.
Of course, auto, you mentioned the initial tariffs against Canada and Mexico would have impacted the auto industry the worst. Fortunately, we don't have too much exposure there.
Health and insurance is a large sector for you, the second largest after BFS. And growth this year in 9 months of calendar year 24 and the prior year was lower than the company average growth. What was the reason for that?
I think there was a lot of growth that happened in this sector. COVID, a little bit post-COVID, for vaccines and new drug discovery. And it came off that highs quite a bit. And I think it's on the path to recovery, but it did come off those highs quite a bit.
Got that.
I'll just add to that. The fact that we are present in 6 different verticals and we service 6 different industries actually helps us, which basically means that when some of those industries are going through their cyclical ups and downs, we are better managed because we are not overexposed to any one industry. And that's the reason why you see our growth rate significantly ahead of the industry growth rate across a period of time, because we are very broad-based in terms of the industries that we serve.
So strategically, do you want to make any changes to the kind of vertical contribution that you have?
Not necessarily. We did make one important change, that we felt banking was underrepresented in our portfolio. So 3 years ago, we formed banking as a separate vertical.
Got it.
It did not exist before that.
Okay. And now it's about 28.3% of your top line.
Banking? No, it's
Banking.
what, 8 or 9% of our top line. Financial services.
Financial services is?
Financial services, 28%.
Okay.
Banking was embedded within financial services, and we thought it was not getting enough focus, so we separated the 2 businesses out.
Got it. And now you're comfortable with the current rate?
Yes.